Most people entering 2026 are asking the wrong question. They're asking, what's the next big investment? Which stock will explode? Should I buy crypto, AI companies, or real estate? But here's the uncomfortable truth nobody wants to hear. The path to wealth in 2026 is exactly the same as it was in 1926, and that's precisely why most people will fail at it. The secret isn't hidden, it's not complex, it's not about insider information or cutting-edge technology. The real challenge is something far more brutal. It requires you to do something that goes against every instinct your brain has developed over thousands of years of evolution. Let me be direct. If you're watching this video hoping for a shortcut, a hack, or a clever trick to get rich quickly, you're already thinking like someone who will stay poor. Not because you're not smart enough, but because you're playing a game you don't understand. Today, we're going to talk about why intelligent people make terrible investment decisions, why the information age has made us poorer, not richer, and why the only path that actually works is the one almost nobody has the psychological strength to follow. This isn't motivational content. This is reality. And reality doesn't care about your feelings. We live in the most connected era in human history. You have access to more financial information than Warren Buffett had in his entire career up until the year 2000. You can check your portfolio value every second. You can read expert analysis from thousands of sources. You can buy and sell assets with a single tap on your phone. And yet, study after study shows the same pattern. The average retail investor underperforms the market. Not by a little, by a lot. In fact, the average investor's returns are so bad that they would have been better off doing absolutely nothing. Think about that for a moment. We have more tools, more information, more access than ever before, and the results are worse. How is that possible? The answer is simple but painful. Information is not the problem. Psychology is. And in 2026, the psychological traps are more powerful than they've ever been. Let me paint you a picture. It's January 2026. You've got money to invest. You open your phone and you're immediately hit with notifications. Market reaches all-time high. Experts predict correction. This AI stock is up 40% this month. Major investor warns of recession. Your heart rate increases. You feel urgency. You feel like you need to do something right now, because if you don't act, you'll miss out. Or worse, you'll lose everything. This feeling, this overwhelming need to act, is the single biggest destroyer of wealth in modern investing. And the platforms, the media, the entire financial ecosystem is designed to amplify this feeling. Because when you feel urgency, you trade. When you trade, someone makes money, and it's usually not you. Here's what most people don't understand. The stock market in 2026 is not a wealth-building machine for those who are active. It's a wealth transfer machine that takes money from the impatient and gives it to the patient. Every time you check your portfolio, you're not gathering information, you're gambling with your psychology. Every time you read a headline about market movements, you're not becoming educated, you're being manipulated. The greatest investors in history, the ones who built generational wealth, all understood one fundamental truth. The market rewards inactivity, not intelligence, not timing, not clever analysis. Inactivity. But inactivity is boring. It doesn't feel productive. It doesn't make you feel smart or in control. And that's exactly why it works. Let me tell you about a concept that changed everything for the wealthiest families in the world. It's not complicated, but it's completely counterintuitive. Imagine two investors. Both start with the same amount of money. Both invest in the same index fund tracking the market. The only difference is how often they check their portfolio. Investor A checks once a year. Investor B checks once a day. You'd think this wouldn't matter, right? Same money, same investments, same market. But the research shows something shocking. Investor B will almost certainly perform worse, much worse. Why? Because every time Investor B looks at their portfolio and sees it's down, even by a small amount, their brain floods with stress hormones. Their ancient survival mechanisms kick in, and sometimes, not always, but sometimes they make a small adjustment. They sell something that's down. They buy something that's up. They move to cash just for a while until things settle down. Each of these small decisions feels rational in the moment, but over time they add up to massive underperformance. Not because Investor B is stupid, but because they gave their emotions too many opportunities to interfere with their strategy. Investor A never felt that stress. They never had the opportunity to make emotional decisions. They were protected from themselves by their own ignorance of daily fluctuations, and that ignorance made them wealthier. This is the paradox of 2026. Access to information has become a liability for most investors. The more you know about short-term market movements, the poorer your long-term decisions become. Now, you might be thinking, but I'm different. I can handle the information. I won't make emotional decisions. And that's exactly what everyone thinks. That's the trap. There's a concept in behavioral psychology called bias blind spot. It's the tendency to recognize biases in others, but not in yourself. When you see someone panic sell during a market downturn, you think they're being irrational. But when you do it, you have reasons, good reasons, logical reasons. The truth is, you're not different. None of us are. We all have the same basic brain architecture that evolved to keep us alive in dangerous environments, not to build wealth over decades. Your brain is designed to avoid immediate threats, not to optimize for outcomes 30 years in the future. Understanding this isn't depressing, it's liberating. Because once you accept that your instincts will consistently lead you astray in investing, you can build systems that protect you from yourself. Let's talk about what actually works. Not theory, not hopeful thinking, what actually, measurably, consistently works. The institutional investors, the family offices managing billions, the endowments that have survived for centuries, they all operate on the same basic principle. Remove emotion from the process. They don't do this through willpower. They do it through systems. Automatic contributions, predetermined allocations, rebalancing schedules that happen regardless of market conditions, rules that eliminate decisions. Here's a specific example. One of the most successful investment strategies ever documented is called dollar cost averaging. You invest a fixed amount at regular intervals, regardless of whether the market is up or down. This strategy is mathematically suboptimal. If you could perfectly time the market, you could do better. But here's the thing, nobody can perfectly time the market. Not you, not the professionals, not the algorithms. Nobody. So the question isn't, what's the optimal strategy? The question is, what's the optimal strategy that a human being can actually execute consistently for 30 years? And the answer is almost always the boring, systematic, emotionless approach. In 2026, you're competing against algorithms that process millions of data points per second. You're competing against teams of PhDs with insider access and billion-dollar research budgets. You're competing against people whose entire career is focused on one narrow sector of one market. You cannot out-analyze these people. You cannot out-react them. You cannot out-trade them. But you can outweight them. Because here's their weakness. They're measured on quarterly performance. They have bosses, clients, investors who demand results now. They're forced to play the short-term game even when they know the long-term game is better. You don't have that constraint. If you're investing for retirement, for your children's future, for long-term wealth building, you have the greatest advantage any investor can have. You can ignore everything that doesn't matter beyond a 10-year time horizon. Most market movements mean nothing over 10 years. Most headlines are noise. Most expert predictions are wrong. Most urgent investment opportunities are traps. And knowing this, really internalizing this, gives you a superpower that most people never develop: the ability to do nothing. Let me tell you a story that illustrates this perfectly. During the 2008 financial crisis, markets collapsed. Some of the smartest people in finance lost everything. Lehman Brothers, a 158-year-old institution, vanished overnight. Panic was everywhere. Two groups of investors emerged from that crisis. The first group, the ones who panicked and sold, locked in their losses. Many of them never recovered. They were out of the market during the entire recovery. They avoided future pain, but they also avoided future gains. The second group did nothing. They watched their portfolios drop 40, 50, sometimes 60%, and they held. Not because they were brave, not because they were confident. Many of them were simply too paralyzed to act, or they had systems in place that prevented panic selling. 10 years later, the first group was still talking about how they got out before it got worse. The second group had not only recovered their losses, but had multiplied their wealth several times over. The difference wasn't intelligence. It was behavior. And behavior is determined by systems, not willpower. Now, let's address something important. I'm not telling you to be reckless. I'm not saying ignore all information and blindly hold forever. What I'm saying is there's a difference between signal and noise, and most of what you're exposed to is noise. Signal is fundamental economic reality. Is the global population growing? Are businesses creating value? Is innovation continuing? These are slow-moving, powerful trends that matter over decades. Noise is everything else: daily price movements, quarterly earnings reports, analyst upgrades and downgrades, political headlines. Most of what fills financial media is designed to make you feel informed, but it's actually designed to make you trade. Here's a test you can do right now. Think about the biggest financial news story from exactly 1 year ago, January 2025. Can you remember it? Can you remember what experts were predicting? Can you remember what everyone was worried about? Most people can't, because it didn't matter. Whatever crisis or opportunity dominated the headlines 12 months ago has been replaced by completely different concerns today. And 12 months from now, today's urgent headlines will be equally forgotten. But the people who built wealth over that year didn't do it by reacting to those headlines. They did it by ignoring them. This brings us to the core concept that separates wealthy families from everyone else: time horizon. Poor people think in days and weeks. Middle-class people think in months and years. Wealthy people think in decades and generations. This isn't about intelligence or education. It's about what you're optimizing for. When you think in days, every market movement feels significant. A 2% drop is a crisis. A 3% gain is an opportunity. You're constantly reactive, constantly stressed, constantly making decisions. When you think in decades, a 2% daily movement literally doesn't register. It's not that you don't notice it, it's that you've trained yourself to recognize it as irrelevant to your goals. This mental shift from short-term to long-term thinking is worth more than any investment strategy because it changes every decision you make. Let me give you a practical framework that successful long-term investors use. It's simple, but implementing it requires discipline that most people never develop. First, define what long-term actually means to you. Not vaguely, specifically. Is it 10 years, 20, 30? Write it down. This is your time horizon. Everything outside this time horizon is noise. Second, calculate how much money you can invest regularly without affecting your daily life. This needs to be an amount that you can maintain even during tough times, not your maximum capacity, your sustainable capacity. Third, choose the simplest possible portfolio: broad market index funds, Maybe a bond allocation if you're closer to retirement. Nothing exotic, nothing that requires constant attention or expertise. Fourth, and this is the crucial part, automate everything. Automatic transfers, automatic investments. Remove all decision points. Your future self will thank you for not trusting your present self to make emotional decisions. Fifth, create what's called an investment policy statement. This is a document you write to yourself explaining your strategy, and more importantly, what will not cause you to change it. Market drops of 30%? That's not a reason to change. Political uncertainty? Not a reason. Media panic? Not a reason. The only legitimate reasons to change your strategy are fundamental changes in your life situation, retirement, major health issues, true emergencies, not market conditions. Your life, not the market. This might sound rigid, it might sound like you're giving up control, but here's the truth. You never had control over the market anyway. What you're actually giving up is the illusion of control, and that illusion was costing you money. Now, let's talk about something that makes people uncomfortable. Most investment advice is designed to benefit the advisor, not you. When someone tells you to actively manage your portfolio, to pick individual stocks, to time the market, to chase performance, they're giving you advice that benefits them. More activity means more fees. More complexity means more dependence on experts. More anxiety means more engagement with their content. The advice that actually benefits you is boring. It doesn't require their expertise. It doesn't generate fees. It doesn't keep you coming back for updates. That's why you rarely hear it. Think about it this way. If a financial advisor told you, buy a diversified index fund, invest regularly for 30 years, and don't call me unless your life situation fundamentally changes, they'd be giving you the best possible advice, but they'd also be putting themselves out of business. This is why the most valuable financial advice often comes from people who aren't selling you anything. They have no incentive to complicate things or to keep you engaged. They can tell you the simple truth. Time and consistency beat intelligence and timing. In 2026, we're seeing a new generation of investors entering the market. Many of them grew up with social media, with instant gratification, with the belief that speed and information equals success, and they're about to learn an expensive lesson. The market doesn't reward speed, it punishes it. The market doesn't reward information access, it exploits it. The market doesn't reward clever trading, it taxes it. What the market rewards, consistently and powerfully, is patience. Boring, uncomfortable, unsexy patience. Let me share something about the psychology of patience that most people miss. Patience isn't passive. It's not about doing nothing because you're lazy or indifferent. Real patience is active. It's about having a strategy and sticking to it despite overwhelming pressure to abandon it. Every day you don't panic sell during a downturn, you're being patient. Every month you continue your automatic investments even when the news is terrible, you're being patient. Every year you resist the temptation to chase the hottest performing sector, you're being patient. This active patience, this disciplined inaction is work. It's hard work. It's just not visible work. Society doesn't reward you for it. You don't get to brag about it. There's no dopamine hit from doing nothing, but it builds wealth. Here's a mental model that helps. Think of investing like planting a tree. You plant the seed, you water it regularly, and then you wait. You don't dig it up every week to see if the roots are growing. You don't try to speed up the process by pulling on the trunk. You don't switch to a different tree halfway through because you heard another species grows faster. You plant, you maintain, you wait. That's it. And 20 years later, you have a tree that provides value for generations. Most investors never plant their tree. They buy seeds, they study seeds, they talk about seeds, they trade seeds with other people, but they never actually plant and commit to the waiting period, because waiting is hard. Waiting is boring. Waiting means accepting that you can't control outcomes, only inputs. But here's the beautiful part. Once you truly accept this, once you internalize that your job is to plant and maintain, not to control and optimize, investing becomes almost effortless. The stress disappears, the constant decision-making disappears, the anxiety about missing out disappears. You're left with a simple routine: earn money, invest a portion systematically, ignore the noise, and let time do the work. That's it. That's the whole game. Now, I know what some of you are thinking. This is too simple. There must be more to it. What about asset allocation? What about international diversification? What about emerging markets and small cap value tilts? And yes, you can optimize further. You can get more sophisticated with your strategy. But here's what decades of research show. The difference between a good, simple strategy and a perfect, complex strategy is maybe 1 or 2 percentage points per year. The difference between any strategy consistently executed and a perfect strategy inconsistently executed is everything. Most people fail at investing not because their strategy was suboptimal. They failed because they couldn't stick to any strategy long enough for it to work. They jumped from approach to approach, always convinced that the next one would be better, never giving any single approach enough time to demonstrate its value. This is the real test of investing. Can you commit to a reasonable strategy and not change it for 30 years? Not because nothing happens. Everything will happen. Crashes, booms, political chaos, wars, pandemics, technological revolutions. And through all of it, can you keep executing the same boring plan? If you can, you'll almost certainly end up wealthy. Not because your plan was perfect, but because you gave compounding enough time to work its magic. And compounding is the closest thing to magic that exists in finance. Let me explain compounding in a way that makes its power visceral. If you invest $10,000 today and it grows at 8% annually, here's what happens. After 10 years, you have about $21,000. You've roughly doubled your money. That feels significant. After 20 years, you have about $46,000. Now you've more than quadrupled your original investment. That's impressive. After 30 years, you have about $100,000. You've 10x'd your initial investment. That's life-changing. But here's where it gets interesting. In the first 10 years, you made $11,000. In the second 10 years, you made $25,000. In the third 10 years, you made $54,000. Notice the pattern? You made more in the third decade than in the first 2 decades combined. That's compounding. The gains accelerate over time, but only if you give it time. Only if you don't interrupt the process. Most people never see the third decade. They interrupt the compounding. They sell during downturns, they reduce contributions during uncertainty, they chase performance and reset the clock. They never give compounding enough runway to truly accelerate. This is the tragedy of modern investing. People have access to the most powerful wealth-building force in history, and they sabotage it through impatience. So here's the real question you need to ask yourself. What kind of investor will you be in 2026? Will you be the person checking prices daily, reading every headline, feeling smart when you make trades, feeling stressed about market movements? Or will you be the person who set up a system, trusted the process, and focused your energy on the things you can actually control: your income, your savings rate, your time horizon, your behavior? One of these paths feels active and intelligent. The other feels passive and simple. But the passive, simple path builds more wealth every single time. Here's my final thought, and it's the most important thing I'll say. Wealth building isn't complicated. It's just hard. Not intellectually hard, psychologically hard. You already know what to do. Invest regularly, diversify broadly, hold for decades, don't panic during downturns, don't chase performance, keep costs low, stay the course. You've probably heard this advice 100 times, but knowing and doing are completely different. The gap between knowledge and action is where most financial dreams die. So the real work isn't learning more strategies, it's building the psychological resilience to execute the boring strategy you already know works. It's training yourself to ignore noise. It's creating systems that remove temptation. It's finding meaning in delayed gratification instead of immediate excitement. This isn't sexy. It won't make you feel smart. You won't have impressive stories about your clever trades. But 30 years from now, when you're financially free and everyone else is still stressed about money, you'll understand something they never learned. The path to wealth isn't about being smart, it's about being patient. And in 2026, in a world designed to destroy your patience at every turn, that might be the most valuable skill you can develop. The question isn't whether you understand this. The question is whether you'll actually do it. Because understanding changes nothing. Action changes everything. And the action required is simple. Start, stay consistent, and don't stop. That's it. That's the secret wealthy people don't tell you. Not because it's complicated, but because it's so simple that most people convince themselves there must be something more. There isn't.